In part 1 of this series, we began looking at 7 investment traits that help us decide which strategy to follow, investing in bond funds or individual bonds. After reviewing 4 investment traits, the score stands at a tie, 2-2. Let's continue with the next topic. Number 5, interest rate risk. Because bonds in a bond fund are constantly being bought and sold, there is no specific maturity date for the money invested in the bond fund. Like all fixed income investments, the money held in the bond fund is subject to interest rate risk. An inverse relationship exists when interest rates increase, bond prices decrease, and vice versa. Hence, when shares are liquidated, they are sold at the current net asset value, NAV, and depending on interest rate levels, the sale could result in a potential loss of principal. Generally, the risk of price volatility and fluctuating principal is higher for bonds with longer maturities. Individual bonds have a defined maturity date. Interest rate risk is avoided by purchasing individual bonds with the intention of holding them to maturity. The market price of any fixed income investment fluctuates prior to maturity based upon the level and direction of interest rates. As a result, barring a credit default, if a bond is held to maturity, it provides principal protection by being redeemed at par value, regardless of prevailing interest rates. Advantage: individual bonds. Number 6, liquidity. With bond funds, liquidity is readily available. If a person needs money for an unexpected expenditure or desires to change asset allocation percentages, an investor may sell shares of the fund at any time at the current net asset value, less redemption fees if applicable. As previously mentioned, depending on interest rate levels, the sale could result in a potential loss of principal. Liquidating a portion of the bond fund changes the amount of the fixed income investment and does not change the characteristics of the fund portfolio. Individual bonds can also be sold prior to maturity. The prices for bonds sold in the secondary market are influenced by prevailing interest rates and, like mutual funds, could be sold for more or less than the original investment. If some bonds are less liquid than others, those bonds may be subject to greater price volatility. It is important to note that short-term objectives and short-term investments should not be mixed with long-term objectives and long-term investments. Hence, liquidity is best accomplished by holding money in short-term cash instruments in order to provide funds for unexpected needs. Fixed income objectives should then be met by separately purchasing bond funds or individual bonds that will be held to maturity. Advantage: bond funds. Number 7, portfolio size. Most bond funds have an initial minimum investment of $5,000 and allow the investment of any dollar amount above the initial minimum. Hence, an investor is able to make a fixed income investment in a bond fund with a relatively small amount of money. Nor does the investor have a size constraint other than what prudence dictates by way of diversification needs and asset allocation strategies. Most individual bonds are sold in $5,000 denominations and may be purchased in much larger blocks depending on the investor's net worth and available funds. However, in my opinion, portfolio size of much under $100,000 doesn't give an investor adequate opportunity to achieve an acceptable level of diversification, either by issuer, bond type, or maturity. Advantage: a tie. Conclusion. So what's the answer? Is it more advisable to invest in bond funds or individual bonds? Is the answer still determined by the summation of each investor's individual circumstances and investment objectives? Let's suggest an answer by reviewing some of the more obvious conclusions and allowing the viewer to decide his or her own investor profile. If an investor, A, desires as much diversification as possible in order to protect against default or credit risk, B, is looking for a quick entry into the fixed income market with the ongoing convenience of automatic reinvestment of interest earnings, C, chooses not to be involved in the underlying investment decisions, D, understands interest rate risk and that there could be a loss of principal if interest rates are higher when shares are sold, and E, is willing to pay management fees and fund expenses, then buy a bond fund. On the other hand, if an investor, A, has at least $100,000 or more of investable fixed income assets. B, wants to retain investment control. C, desires relatively predictable income. D, intends to hold bonds to maturity. And E, is looking for lower expenses by virtue of buying bonds online directly from the secondary market than by individual bonds. In my opinion, gradually more and more investors will be attracted to the advantages of purchasing individual bonds. And as investors learn the ease of buying individual bonds online, the investors shift from buying bond funds to buying more individual bonds will likely accelerate. Nevertheless, decide which type of investor profile you are and start investing. Thanks for watching. To learn more, visit zionsdirect.com.